Hello everybody, my name is Shipra Singh and I welcome all of you to another video on basic accounting interview questions and answers from CareerRide. In part 1 of the video in this series, we covered commonly asked questions on important topics like bookkeeping, journal, ledger, subsidiary books, bank reconciliation statement, rectification of errors and the balance sheet. In part 2, we discussed basic but essential questions related to non-profit organizations and partnership. In addition to these, we have also shared detailed videos on accounts payable and accounts receivable. So make sure to check them out also. Today, let's move a step forward and see some important interview questions on basic topics like trading account, cash book, cash flow statement, depreciation and its methods, provisions and reserves, asset disposal account, and a very important topic, the fund flow statement. If you're really serious about cracking any accounting interview, the questions covered in these videos are a must know. Make sure you watch this video till the end without skipping any part of it. And once you are done with this video, don't forget to check out other videos also. The links are provided in the description box below. Ready? Fantastic. Let's start. Question number 1. Can you name the final account we prepare in case of sole proprietorship? Quite simple and easy. The final accounts that we prepare in case of proprietorship are trading account, P&L account and balance sheet. Trading account and P&L account are together known as income statement, and 3 of them together are known as final accounts. Going a little deeper, your question number 2 can be, why is income statement created? Now see, income statement means trading account plus P&L account we just saw. So the question basically is, why are these 2 created? To answer the question, let's go to our basics. Trading account helps you determine gross profit and loss, and P&L account helps you determine net profit and loss, which you are interested in finding out as a business. The figures you get from here allow you to compare with the previous year's profits. This gives you an idea about the direction in which the business is going. The details of your income and expenses are very, very important because these allow you to control them better. You are able to find a clear picture about the reserves the business has, just in case you meet some uncertainties. And then you are able to calculate the ratios like gross profit ratio, net profit ratio, etc. with the help of these documents. So you see, both of these documents allow you to get a deeper look into your business, based on which you can make your decisions, and that is why it is very important for a business to prepare them. Now, the next 2 questions that I'm going to bring before you can be the follow-up questions to this question number 2. And the questions can be, tell us a bit about trading account. So see, trading account is a financial statement that shows the result of buying and selling of goods and services in a given period. It helps determine the gross profit or gross loss of the business. On the debit side, it records things like opening stock or inventory, net purchase and direct expense. These purchases only include the goods and material bought with an intention to resale. They do not include any assets bought by the company like land or machinery, etc. Now, the important thing to pay attention to here is direct expenses are the expenses you incur in the process of production. Example, your wages, power, fuel, factory rent, royalties, duties on purchase, carriage, that is freight, etc. On the credit side, you have sales, services rendered, closing stock of the inventory. The difference between the 2 sides tells you if it is a gross profit or loss for the business. If the total of credit side is greater than the total of debit side, you make a profit and vice versa. The gross profit or loss is transferred to the P&L account. Your question number 4 can be, tell us something about P&L account. Now, P&L account is the second step in the preparation of final accounts and shows the financial performance of an enterprise. It pertains to a particular accounting period and follows accrual basis of accounting. Items like gross profit, indirect income are recorded on the credit side of the statement. Indirect income includes things like rent received, discount received, commission earned, interest received, etc. So you see, this indirect income is the income you receive from sources other than selling your product or service. Now, what do you record on the debit side? So, debit side records items like gross loss and indirect expenses. These indirect expenses can include things like salaries, rent, stationery charges, advertisement cost, any legal charges you have paid, telephone charges, depreciation, interest, etc. The important thing to mention here is the net profit or loss that you get from here impacts the capital of the organization. It either makes the organization stronger or weaker. Now, our next question is a tricky one that's usually asked here. Pay attention. The question is, can we say that trading account is a part of P&L account? So yes, we can say that trading account is a part of P&L account because the gross profit or loss you post to the P&L account is ascertained from trading account only. This is simple, but many candidates get confused here. Make sure that you don't. Coming to another important question, tell us a bit about the balance sheet. Okay, so balance sheet is a statement that shows the financial position of a business on a given date. It records all the assets and liabilities of a company on a given date. It is prepared from real and personal accounts. Excess of assets over the outside liabilities is the capital and demonstrates the financial soundness of the company. And since everything is recorded in an organized manner, it shows the amount of assets a company owns under a particular head also. At the same time, it also shows the amount of liabilities it owes to the outsiders and the proprietors. It provides the base for the opening entry for the next accounting year and helps you understand the solvency status of the company. With the next question, the interviewer might go a little deeper. And the question can be, which items are recorded on the assets and liabilities side of a balance sheet? So see, liabilities represent the obligations or debts of the business. These may be external liabilities, that is payable to the outsiders, or the internal liabilities, that is owners' funds. Common items that are included here are sundry creditors, bills payable, bank overdraft, EPF, loan and advance taken, that is the credit balance of it, reserve or reserve fund, capital of partners, etc. And the assets represent what the business owns, both current and non-current. They can include items like cash in hand or bank, then your bills receivable, sundry debtors, loans and advances given, that is the debit balance of it, closing stock, investments, furniture and fittings, plant and machinery, loose tools, then your land and building premises, and then your patents and trademarks, goodwill, all of these are included under the assets part of the business. Okay, let's move on to a very tricky question with this. What do you know about the terms grouping and marshalling? Now see, if you are not prepared, this question is going to come as a big surprise to you. So pay attention. Both of these terms, grouping and marshalling, are actually related to the presentation of balance sheet. When you list all the items of similar nature under a specific accounting head, it is called as grouping. For example, your current assets is a group which includes things like cash at hand, cash at bank, inventory, debtors, etc. Similarly, sundry creditors, bills payable, outstanding expenses, all of these are grouped under current liabilities. Marshalling is an arrangement of assets and liabilities in a particular order in the balance sheet. It deals with the order in which these assets and liabilities are presented in the balance sheet. The two most commonly used methods of this arrangement are, the first one is in the order of liquidity. That is, the assets are listed from most liquid to least liquid. And the second one is in the order of permanence. In this case, the assets are listed from most permanent to least permanent. For example, your land and building, plant and machinery, stock, debtors, cash, this is the order. Okay, if need be, please feel free to replay this question, but make sure that you have understood it properly. Great, let's move on to question number 9 with this. Tell us something about the cash flow statement. Another important question. So see, cash flow statement is a tool that is used for financial analysis. It shows how the cash flows in and out of the organization. And the best part is, it gives us the specific reasons for the difference between the opening and closing balance of the cash in the organization. That is, where did the cash come from and where did it go? You get a clear picture of this. Cash inflow happens from activities like cash sales, cash received against the trade receivables, commission or royalty, then your insurance claim that you have received, cash from sale of investments, sale of fixed assets, sale of securities, loans and advance received, then proceeds from the issue of equity shares, preference shares or debentures. All of these are your sources of cash. And cash may outflow for payments like cash purchases, cash that you pay against the trade payables, operating expenses. Then if you buy any investments, cash purchases of any fixed assets, loans and advances that you give, or if you buy back any of your equity shares for cash, that is a payment. Then redemption of preference shares, redemption of debentures, all of these items are where the cash goes out. So the cash flow statement actually gives a very clear picture of the liquidity in an organization and is extremely useful for creditors, investments and management to make informed decision about that particular business. The follow-up question to this can be, what are the advantages of preparing a cash flow statement? So see, cash flow statement first of all helps with short-term planning for the business, because now you precisely know your sources and applications of fund. What this does is, it allows you to have a better control over both of these things. It also helps you assess the liquidity and solvency of an organization. That is, your ability to pay for your short-term and long-term liabilities as an organization. And now, since you know if there's a surplus or deficit of cash in the organization, you're able to manage your cash more efficiently. And you're also able to compare your actual cash flow statement with what you budgeted for. So it provides you a comparative study also. What's going right, what's going wrong. You get a clear picture of that. And you also get a clear understanding of the actual reasons for the current status where you are at and what corrective actions are required if you want to emerge out stronger from here. Okay, now we are moving to a little practical question. Pay attention. The question is, suppose you deposit the cash you have in hand into your bank account. Will this be regarded as cash flow? So no, this transaction cannot be regarded as cash flow. Why? Because it is simply that the cash is changing the place in this case. There's no inflow or outflow of cash happening here, right? Similarly, if you withdraw cash from your bank, it won't be regarded in the it won't be recorded in the cash flow either, because what is happening here again is it is changing the place. There is no inflow or outflow of cash happening here. Question number 12. Can you name some commonly used subsidiary books? Okay, so first of all, let's quickly see what are subsidiary books. We know that all the transactions in a business are to be recorded and they are recorded in a journal book. Now just imagine that the business is growing up and you keep recording all the transactions, sales, purchase, cash, everything in one journal book. Will you be able to locate a specific entry in the time of need in this case? It will be difficult, right? So what do we do here? We record the entries in separate dedicated books. For example, record sales of goods in one book, purchases in another, cash transactions in another, and so on. What are these books? These books are called as subsidiary books. There are 6 types of subsidiary books that you have. Cash book, purchase book, sales book, purchase return book, sales return book, and journal proper. Okay, now pay attention, because the next question tests your conceptual knowledge and is one of examiner's absolute favorites. The question is, do you pass the journal entry for the transactions that you have recorded in the subsidiary books? So no, the journal entry for the transactions that you have recorded in subsidiary books is not passed. The total of the subsidiary books is directly posted to the ledger. For example, if you have a purchase book, you would directly pass on the total to the ledger. Why? because you have already entered everything, you have already passed on the entries in the subsidiary books. Okay. Now let's move on to a question on depreciation, which is another important topic. The question is, what is depreciation? So first of all, depreciation means fall in the book value of tangible assets. This fall is permanent, gradual and continuing in nature, which means that the value of these tangible assets falls slowly, continuously and cannot be reversed. It is actually an expense that doesn't involve cash, and since it is an expense, it is debited to the P&L account. Now, the important thing to notice here is depreciation reduces the book value of the goods, but the market value may not necessarily fall. While your books may say that the value of your furniture is 10,000 rupees after depreciation, you may still manage to find a buyer who buys it for 15,000 rupees, which is the market value of your asset. And a very important thing to remember here is depreciation accounting is actually the process of allocation and not valuation. Now, for those of you who don't know what allocation means here, when you distribute the cost minus salvage value, that is the scrap value of an asset, over its useful life, it is called as allocation. Now, this question is asked so many times in the interview and a lot of candidates get confused here. So, make sure that you are clear with it. Pay attention, and if you need, please replay this much part of the video, that is this question, so that you can catch it better. Now, the follow-up question to this can be, is depreciation charged on all fixed assets? So yes, depreciation is charged on all fixed assets except land. Why not land? This is because land has an infinite economic life. Another important thing to know and remember for the interviews, pay attention. Moving on to question number 16 with this. What is the difference between depreciation, amortization and depletion? So see, fall in the value of tangible assets due to use, passage of time, obsolescence or accident is called as depreciation. Amortization is also fall in value, but it applies to intangible assets, that is your patents, copyrights, the goodwill, etc. And depletion, it is used in context of exhaustion of vasting assets like your quarry, mine, etc. So when you keep mining coal, the coal reserves deplete in that sense. Question number 17. What would happen if you do not charge depreciation? Okay, so we know that depreciation is an expense. Now just imagine, if you do not consider an expense altogether, what would happen to your financial accounts? Would your P&L and statement show the correct financial position of your business? Would it not show unnecessarily exaggerated value of your assets? The value of your asset would reduce with time and use, but if you do not charge depreciation, the books would show unnecessarily extorted value of these assets, which will be misleading for you as a business owner. Depreciation is considered while calculating the cost of production also. If you don't consider it, your cost of production will show up lower than what it actually is, and you would not be able to price your items or products properly. Then if you charge depreciation and retain it in the business, it provides you the funds to replace the asset that is under consideration. Otherwise, if you do not charge this depreciation, you won't be able to provide for this. And lastly, for legal compliance, it is very important to charge depreciation. Now see, this question is again very important. Please feel free to replay it if you have not got it completely. But make sure that you have understood it well and you are prepared to answer it in the interviews. Moving on to another important one. Name the factors you consider for providing depreciation. Now see, the three important factors you consider while providing depreciation are: number one, the historical cost of your asset. Basically, how much did it cost in all to get the asset to the factory and functional? This could include your cost of the asset, the freight that you might have paid, installation charges and any other cost to get it operational. Then your estimated residual or scrap value that you can receive at the end of useful life of this asset, and the estimated useful Economic life of the asset is the third important thing, the third important criteria that you need to take into consideration while calculating the depreciation. Because every tangible asset would have an estimated life. But the exception here is land, as we just discussed a while back. Because the land has got unlimited economic life. Now, a natural follow-up question to this can be, what are the different methods of charging the depreciation? So see, there are two prime methods of charging the depreciation. The first one is when depreciation is charged to the asset account. And the second one is when provision for accumulated depreciation account is created. Simple till here? What's important actually here is the entries you pass to record these. Let's see them. Let's see the entries according to the first method. That is when the depreciation is charged to the asset account. In this method, we directly reduce the value of the asset by charging depreciation to it. This means the asset now appears in the books at its written down value. So the two entries that you pass are these. This entry reduces the value of the assets in the books. And this entry is passed at the end of the accounting period to close the depreciation account and reflect it as an expense in the P&L account. Pay attention again, two very important entries that are very, very important from the point of view of the interview. Now, the second method is when you have a provision for the depreciation account. This method is used when we do not reduce the assets value directly, but instead we maintain a separate account which is called as the provision for depreciation or accumulated depreciation account. How would the entries look in this case? The entries would look like this in this case. The first entry here increases the provision, that is accumulated depreciation, without directly reducing the asset in the asset account. And this second entry, if you look at it closely, this is the same closing entry as we saw in the method 1. It is used to transfer depreciation expense to the profit and loss account at the end of the accounting period. This is quite easy, but at the same time, it is very, very important to know these entries because interviewers especially love such questions. Please feel free to replay this question, pause the video on both the slides and take a good look at the entries. They'll help you tremendously during the interviews and definitely make you stand out from other candidates who are present there. Our question number 20 is, what are the different methods to calculate depreciation? Now, there are two most commonly used methods that are used for calculating the depreciation. The first one is straight line method, which is also called as fixed percentage on original cost or fixed installment method. What happens in this method is a certain percentage of the asset's cost is written off every year as depreciation. For example, 10% depreciation on the original cost every year. Now this means that the depreciation every year is uniform and hence the name is straight line method. The second method that we use is written down value method, that is diminishing balance, reducing installment method or reducing balance method. It is also called as by these names. In this case, the depreciation is charged on the book value of the asset, which keeps reducing every year because of the depreciation that you have charged in the previous years. And that is how these two methods are different from each other. Okay, let's move on to question number 21 now. What do you understand by provision? So see, provision is an amount that is charged to the profit and loss account to provide for a known liability. The amount of which can't be determined with certainty, but it can be estimated reasonably. Since it is charged on profit, it reduces the net profit for the year. For example, it could be the provision for depreciation, doubtful debts, then repairs, taxes, etc. When you don't know the exact amount you would need to pay for something, provisions are created. So you see, it is like a temporary retention of profit for a specific future obligation. It helps the business stay prepared for expected but uncertain expenses. Great. Let's move on to question number 22 with this. What are reserves? So see, reserves is the amount that you set aside from profit to meet known or unknown future contingencies that may arise. They are not created to meet any specific liability, but the basic purpose to create these reserves is to strengthen the overall financial position of the organization. Reserves represent appropriation of profit. For example, you may create a general reserve, reserves for expansion, reserves for increased cost of replacement, etc. Now, most of the candidates would stop their answer here itself. But if you want to stand out, try adding some more details. For example, some of the important things about reserves that you can talk about are: reserves belong to the proprietor. They appear on the liability side of the balance sheet because they represent profits that have been retained in the business, which are owed to the owners actually. When reserve is invested in outside securities, it is called as reserve fund. So these are the additional details that actually add weight to your answer. Also, you can go on to say that reserves are debited to the profit and loss appropriation account, not to the P&L account as it is. That's why they do not affect the net profit. They are created after the profit is already determined. Now, you can see yourself, a new question is getting created here, which may be asked just as a one-liner. For those of you who do not know what appropriation is, appropriation means distribution or allocation of net profit after all the expenses, taxes and adjustments have already been made. So if you see in simple words, once the profit is finalized, a part of it is set aside or distributed, this is called appropriation of profit. Simple? If need be, I highly recommend that you replay this question and try to get a hang of it, because this is a very important question that is usually asked in the interviews. Question number 23. What are the various types of reserves? Now see, there are two types of reserves. The first one is revenue reserve. This is created out of revenue profits. That is the revenue that you have earned from your main business. And the second one is capital reserve. This revenue reserve can be further classified into general reserve. That is, it is the amount that is set aside for general purpose, not any specific purpose. They strengthen the financial position of the company. And the second one is specific reserve. You set aside a specific reserve and this can be used for that specific purpose only. So you see, this is for a particular purpose. For example, workmen compensation reserve, debenture redemption reserve, etc. Now let's come to capital reserves. Capital reserves are set aside from capital profits that you make. For example, you may sell a land or something like that, and you may reserve some amount, that is capital reserve. And these capital reserves are not available for distribution of dividend in normal cases. Capital profit can arise from selling your fixed assets, redemption of debentures, then selling of shares, premium issue of shares or debentures, etc. So this extra information is to give you an insight into what capital profit may consist of. Okay, let's move on to question number 24 with this. Okay, now question number 24 is very interesting. Have you ever heard of secret reserve? So yes, secret reserve, it is also called as hidden reserve. It is a reserve whose existence is not explicitly shown in the balance sheet, as the word itself suggests, secret. It is created deliberately to strengthen the financial position of the company without disclosing it openly. Now, the question that arises here is, how is it actually created? So, you create this reserve by showing the assets at a lower value and liabilities at a higher value. Also, you try to write off the assets at a higher value. This reserve basically shows a conservative picture of the organization's financial position and safeguards its interest in any unforeseen losses, right? Okay, let's move on to question number 25 now. Suppose I sell off an asset before its book value becomes 0. How would you charge the depreciation in this year of sale in this case? Now, you can pause the video for a moment, take a good look at the question. Now, if you try to simplify the question, it is basically asking you is, how much depreciation would you charge in the year of sale of an asset? Doesn't it? Now it becomes easier. Fantastic. Let's see what happens here. So we know that we charge the depreciation for the whole year, that is 12 months of the financial year. Suppose I sell the asset at the end of 6 months only in that year. So my depreciation would be charged for these 6 months only. It won't be charged for the whole 12 months. Right? Does that make sense? Great. If need be, you can replay this question again and gain the clarity if you need to. The question is simple. It is just asking you how much depreciation would you charge if you sell the good before the year ends, if some months are still remaining. Okay, moving on to another interesting question. Are the sales proceeds always equal to the book value of the asset? Now, it's simple but actually a tricky one and definitely one of the interviewer's favorites. That is why I've got it here. So, the book value of an asset, we know, is its value after the depreciation has been charged, and sales proceeds is the value you actually managed to sell this asset at, right? And all of us know that these values can be absolutely different. For example, the book value of your asset after charging the depreciation might be 1 lakh rupees. But in the real life, you may actually manage to sell it for rupees 1,20,000, or you might have to sell it for 80,000 rupees. If you manage to sell it at a price higher than the book value, it's profit, and vice versa. Okay? So we can see that the book value and the actual value, the sales proceeds, do not always have to be the same. And actually, if you see, they are rarely the same. Great. Now we are moving to another very important topic, that is fund flow statement. So the first question from fund flow statement could be, are there any other names used to refer to the fund flow statement? This one is very simple, very basic, still good to know. So the fund flow statement can also be called as statement of changes in financial position. Then many a times it is also referred to as statement of sources and applications of funds. And a more casual common one is where got and where gone statement. Informal but often used to explain in simple terms where the funds came from and where they actually were used. Okay, now our question number 28 is, why do organizations prepare the funds flow statement at all? So see, there are several important reasons for the organizations to prepare a fund flow statement. The most common ones are, number one, to monitor and control the working capital. Because this statement shows whether the organization has a surplus or deficit of the working capital and whether the existing working capital that you have has been used sufficiently efficiently or not. That is the first purpose. And then this statement also gives you the causes behind the changes in the working capital. And all of this helps the management understand the exact reasons for any increase or decrease in the working capital during that particular period. Then it also helps you with better financial planning and budgeting, because by knowing where the funds are actually coming from and where they are being used, companies can plan their future finances and budgets more effectively. And banks often require projected fund flow statements before they sanction your loans, along with other financial documents. So that is why also this fund flow statement is very, very important for any organization, because it plays a vital role in loan approvals. So all of these are the most important reasons why fund flow statement is actually generated. Why is it actually created? Okay, now let's move on to another practical question. And this one is also very popular with the interviewers. So pay attention. The question is, how would you know if a particular transaction would have the impact on fund flow statement or not? Now see, this one looks difficult, but is actually very, very simple. Funds refer to working capital. So if a transaction causes a change in the working capital, it means it has an impact on the fund flow. Otherwise, it has no impact. Now, what I'm going to give you next is a very simple tip to identify this. Pay attention. When you make the journal entry for any transaction and you see that one account getting impacted is from the current category, while the other one is from the non-current category, there would be a change in the working capital in this case. And hence there would be a flow of fund. If both the accounts belong to the same category when you make these journal entries, that is current or non-current, whatever it may be, there won't be a change in the working capital. Okay, so this was in theory. Let me show it to you practically. Suppose I purchase some machinery and the cost is 50,000 rupees that I pay in cash. How would the journal entry look like in this case? The journal entry would look like this in this case, right? So do you see that these are two different types of accounts? One is non-current assets and the other one is current assets. So one is from non-current category and the other one is from current category. So there is going to be a change in the working capital. There's a flow of fund that is happening here. Now, if I buy the same machinery on credit, let's say, how would the entry look like in this case? The entry would look like this. So do you see, these are again two different category of accounts. One is non-current, the other one is current. It implies that there is a change in the working capital. If there is a change in the working capital, it means there is a flow of fund. Right? Easy now? Now let's see a case where both the accounts are of the same category so that you can get a good grip of it. Suppose I finish off a current liability by paying cash to a creditor. What would the journal entry look like in this case? The entry would be like this. Do you see, both the accounts here are from the current category. Current liabilities, current assets. Right? They are similar category. It means there is no change in the working capital. There is no flow of the funds happening here. This is actually very important question. If need be, you can replay this much part of the video, but make sure that you have absolute clarity on this because there is a very high chance of interviewers asking this question. Okay, with this, let's move on to the last question of this video, which again tests your conceptual knowledge. The question is, what are the different elements considered under source and application of funds in a fund flow statement? Now, in a fund flow statement, the sources of funds and application of funds refer to the movements that actually either increase or decrease the working capital. So, the sources of funds can include things like funds from operations, that is your main business, then issue of shares, debentures, sale of fixed assets or investments, long-term loans that you may have taken from the bank or somewhere, then your non-trading receipts that come from business activities like donations, your insurance claim that you may have received or government grants, all of these come under sources of funds. Now, applications of funds means things that actually lead to the decrease in working capital. It can include things like loss of funds from operations, repayment of long-term loans that you may have taken in the past, purchase of fixed assets, redemption of preference shares, debentures. Then your non-trading payments. For example, if you have proposed dividend, provision for taxation that you may have, all of these are your applications of funds. So friends, with this we come to the end of this video and I sincerely hope that whatever we have discussed today is going to be useful to you in cracking your next interview. If you are someone who is preparing for your accounting interview, make sure that you watch the videos that I am currently showing you on the screen also. You'll find the links in the description box below. If you have found today's video useful, do give it a thumbs up and share it with your friends also. And to keep receiving more such videos, you know what you have to do. You have to subscribe to the channel. I'll see you very soon with a new video. Till then, bye-bye and take care.